Thank you, George. It's so nice to be with you folks. We'll spend the time, you can interrupt with questions anytime. I have a lot of material here. I don't know if we can cover it all. Basically, tonight, what I'd like to talk to you about is what is safe and cheap, and compare it, do some analysis, compare safe and cheap with what Graham and Dodd have done in security analysis, the last edition of which was published in 1962. By way of background, when I went in business for myself, I was heavily involved with distress investing, which is the bankruptcy statutes in the United States, today Chapter 11, CCAA in Canada. And my swamp was and is, as a distressed investor, to try to acquire at a discount the most senior credit instrument that's going to participate in a reorganization, either in the U.S. or Canada. I give you that by way of background because I think it's a seamless introduction to safe and cheap. I will pose the question to you of if a company has an extremely strong financial position, what is the most senior issue that will participate in the reorganization? Without further ado, let me tell you, it's the common stock. And the first characteristic of safe and cheap, of the four characteristics, are we, under safe and cheap, don't own any common stock unless the company has an exceptionally strong financial position. In other words, we're acutely conscious, first and foremost, of the quality of a balance sheet, again, which is somewhat unlike Graham and Dodd, believe it or not, who basically focused on the quantity of the balance sheet, to wit, book value. Having a strong financial position is a combination, or one of three elements. First, and what's most important to us, a relative absence of liabilities, whether on the balance sheet, in the footnotes, or out there in the world, in strong balance sheets. We don't do tobacco. We don't do it. We don't get subordinated to asbestos claimants, no matter what the disclosures are. We want a relative absence of liabilities. The second element, which turns out to be very important to us, is that as I go through our portfolio, is companies with very high quality assets, which mostly means assets that are either cash or readily convertible into cash. More about that later when we talk about net nets. The third element that might contribute to a strong financial position are businesses which have a large and reliable free cash flow available for the common stock. That is far rarer than most people think it is. Anyway, that first characteristic for safe and cheap, as far as safe, is we don't invest in common stocks unless we believe the company has a reasonably strong financial position. The second element of safe is we want the companies reasonably well managed by managements and control group groups that are cognizant of the interests of outside passive minority investors. Unlike what you read in academic finance, if you use Greeley and Myers or Ross Westerfield, agency costs are not a big deal, really. You should look at the relationships between outside stockholders and managements as a combination of communities of interest and conflicts of interest. We like to be in positions where the communities of interest dominate, knowing that there always will be conflicts of interest. On this second thing, this appraisal of management, I always say we screw up here more than any other place in Safe and Cheap. I really don't know if that's true today. I go down our list of major holdings, and one after another, the companies are magnificently managed by people with whom we're very pleased. The third characteristic of SAFE is we only invest in businesses we understand. Understandable can mean many things, but for us, understandable always means complete disclosure, very good disclosure, and audited financial statements which we rely on not to tell us the truth, but to give us objective benchmarks. Again, more about that later. Again, a comment about Graham and Dodd, and as they wrote in 1962, compared with us, they were much too much relying on GAAP as reported. We don't rely on GAAP as reported. We think of GAAP as something the only thing that gives us objective benchmarks numerically, which is then up to us to take those objective benchmarks and determine what economic reality is based on the tools given us by GAAP. It's quite different. Those three things, strong financial position, reasonable managements, understandable businesses, constitutes safe, constitutes cheap. For us, constituting cheap means buying at a big discount from what the common stock would be worth with a business, a private company, or a takeover candidate. In the Third Avenue portfolio, what specifically cheap is refers to 85% of the portfolio which we acquired at what are very substantial discounts from readily ascertainable net asset value. That's what we focus on. We're interested in common stocks that are available at readily ascertainable discounts from net asset value. Now, let me just interrupt here to say that virtually all of the Third Avenue portfolio, in meeting this criteria, invested in the common stocks of financial institutions and real estate companies. We really don't have any investments in businesses associated with the old line American manufacturing economy. Much to our luck, it was sort of dumb luck, grew out of the financial position. In the 80s, I did rather well being a creditor of Johns Manville in their bankruptcy occasioned by huge asbestos liabilities. From the education in John's Manville, I said to myself, I will never, ever knowingly be subordinated to an asbestos claim. All of which meant, as far as I could tell, there was no American manufacturing company that didn't have asbestos liability. So it's sort of our mantra. Industries pick us more than we pick them. And what we do is now very concentrated in financial institutions and real estate securities. George, have anybody seen the book Dear Fellow Shareholders, which is a compendium of 15 3/4 years of stockholder letters by Third Avenue? I didn't hear.
I believe he said no.
Huh?
I believe he said he didn't think so.
I'm reading this here.
I'm gonna, how many, we have some copies. I'll send you 5 or 10 copies tomorrow because I'm gonna refer to various letters which I think are helpful in,
That's because I find this very useful, and I was hoping to finish it and then put on a reserve for the students, but if you send a few more copies, would be great.
Yeah, how many? 10 max, George. We're running out. You'll take care of that, Bridget?
Absolutely.
All right. I'll give you the address. In other words, to put it this way, you've all read Graham and Dodd. We buy nets. However, our determination of what's a net is very, very different from what Graham and Dodd define as nets. And I'll refer you here to the January 31st, 2006 letter to shareholders. I'll get back to it, which compares Graham and Dodd nets with Third Avenue Value Fund nets. I'll talk about that in a minute. But at the moment, on the 4 characteristics, I've summarized what safe and cheap is, how we practice safe and cheap. Before I go any further, let's talk about what's wrong with safe and cheap. Certainly what's wrong with it as we do it. First, to buy, there isn't that much magic in the world. Normally, I don't know if that's true today. I don't think it's that true today. But normally, for us to get our requisite pricing, the near-term earnings outlook has to suck. It's that simple. We're not gonna buy growth stocks at half a book value at a time they're selling at 6 times earnings. It'd be more like 30 or 40 times earnings most of the time. No, I don't think it's true with today's portfolios again. Second, so that basically, in order to do safe and cheap and follow our presets, you're a long-term investor, you ignore the near-term outlook. 2, like ourselves, we are in bed with ultra-conservative managements. Otherwise, why would they have those huge balance sheets? We like it that way, but I would think with the ultra-conservatism over time, we get our share of deadheads. Again, I don't think it's true of our present portfolio, but it's one of the things that's normal. You're dealing with people who willingly sacrifice return on equity at the present time for the insurance effect of having a very strong financial position, and for the better people, the flexibility that's inherent in having a strong financial position that allows you to be opportunistic that companies who are supplicants to creditors never can be. Also, the managements we're in bed in, almost without exception, are non-promotional. One of the things about the big, strong balance sheets is these are companies that don't need access to the capital markets, certainly don't need access to equity markets. So they tend not to be all that interested in Wall Street, which is quite logical. It sort of goes along with market efficiency. And finally, one of the things wrong is we pay attention to what is the safe and cheap, the long-term. We have a 5-year, 10-year horizon. Last year, Third Avenue Value Fund had a portfolio turnover of 7%. So among the things we ignore is marketability and liquidity. Or in plain English, in our investments, we tend to buy into a fair number of what are called roach motels. It's easy to check in, but you can't check out. And if we've made a mistake, we always sell right away, and we do tend to have a thin market problem on individual securities. So I'll admit, when we were living through all those redemptions during the bubble in 98 and 99, we, like all other value funds, were suffering pretty massive redemptions. We didn't have any trouble meeting the redemptions by selling portfolio securities. One of the big problems with safe and cheap, and I think with all value investing, and I think with Graham and Dodd as well, the discipline works a hell of a lot better on the buy side than it does on the sell side. I think, when we buy, we put so much emphasis and so much study into what can go wrong, that we don't bring that same thing to the sell side. So what we do is, obviously we have very, very little turnover. That's because I've had a long career of holding securities which doubled in 3 years, and I sell it to somebody else for whom it tripled in the next 6 months. So we just basically, if we're in a good company, we'll just stay with it. Value is dynamic. Like I say, when we buy at these discounts from readily ascertainable net asset value, one of our criteria to going into companies is we want to have a belief that they have excellent prospects for increasing the net asset value on a long-term basis by a factor of something greater than 10% per annum compounded. So far it's been pretty good, but anyway, those are our criteria. As for sales, we sell if we made a mistake. And we judge mistakes not by market price performance, but rather whether or not we think something has arisen that threatens a permanent impairment. To use the accounting phrase, the two common things in permanent impairment are dissipation of a strong financial position or competitive forces make the business not feasible. We also sell if we think the securities become grossly overpriced. We're not that good that it happens that often. Most of our portfolio, we have quite a number of 10 baggers in the portfolio, and they still, that's a tenfold increase, and those that we hold are still look reasonably priced, reasonably attractive, though maybe not as cheap as when we bought them. One of the reasons for selling is portfolio considerations. I mentioned 98, 99, is in the various portfolios we have in Third Avenue, we keep getting in net new funds. Little pressure to sell. As might be the case if we had a fixed size portfolio, or obviously would be the case if we had a shrinking portfolio and had to meet redemptions. Now, I want to make one very important point, and I want you to mark it well because you, as far as I know, you don't read it in any literature. You cannot use the word risk without putting an adjective in front of it. There is market risk, there's investment risk, there's commodity risk, there's failure to match maturities risk, there's interest rate risk, but there really is no general risk. If you're going to use the word risk, you ought to define what you're referring to. In Safe and Cheap, we break our backs to try to avoid investment risk. Investment risk being defined as something that goes wrong fundamentally with the company in which we're investing or the security. Market risk refers to fluctuations in prices of securities. I don't know what text you're using, but whether it's Greeley or Myers or Ross Westerfield, all they ever talk about is market risk. They wouldn't know investment risk if they fell over. It is not something on our radar screen. Admittedly, market risk ought to be on your radar screen if you don't know anything about the companies in which you're investing, if you're on margin, if you might lose your job if you don't outperform an index next month. That has nothing to do with Safe and Cheap. It certainly had nothing to do with Third Avenue. For those of you who are going to go in the investment business, I suggest you very much try to get with value people who are infinitely more conscious of investment risk than on market risk. I have been in business over 50 years, and I'm still waiting for the first night to lose sleep because I have to worry about a portfolio. It just doesn't happen. I think our 18 analysts here are basically very happy people, in great part because they don't get the pressure that they have to outperform an index consistently, which is what academics say should be the goal. Outperformance consistently happens to be a dirty word. It means all the time. No, but nobody does that. Nobody should try and do that. What we strive for in performance at Third Avenue, and I think is the case for all value investors, is outperformance most of the time on average and over the long term. It is a phony standard for any value investor to say that his goal is to outperform consistently. Let's go for a minute, as long as we're doing this, to Graham and Dodd. I want to talk about that and the 62 book. The greatness of Graham and Dodd is that in common stock investing, and this goes for the 71 edition as well as 62 and 40 and 34, in common stock investment, they postulated terrific caveats to follow if you didn't know much about the company in which you were investing. They treated the companies as strict going concerns and had a statistical approach. At the end of the day, said most weight should be given to the long-term earnings record. I think absolutely appropriate where you don't know much about what you're investing in. They did the same thing about dividends when they talked about the importance of dividends, for one thing, as a check on the reliability of earnings. And if you didn't know, and they have this great thing, if there are two companies, A and B, exactly the same, and A pays a higher dividend, A will sell at a higher price, therefore A is a more attractive security. Completely forgetting about what question they should have asked is which security should you buy, A or B? B, by their calculation, which they didn't do, would really be cheaper and really have a better outlook, at least because they had more retained earnings to reinvest. But their head was quite properly, I think, was let us place great reliance on dividends, in part because it's an anchor to windward when we really don't know if the income statements are done appropriately or not. The thing that happened is we had, in the U.S., and I guess it goes for Canada too, we had the Securities Act amendments of 1964, which triggered a disclosure explosion, unavailable and unvisualized by Graham and Dodd. Nowadays, just by doing the public record for many companies, not all companies, certainly all the companies we're involved with, just by relying on the public record, we can gather so much knowledge that Graham and Dodd never believed was available. And it's gotten better and better and better. I think one of the proofs during the 70s and 80s was the hostile takeover movement, where, by and large, people involved in hostile takeovers were very successful, and most of the surprises they were stuck with when they took over a company were pleasant surprises, not unpleasant surprises. And it was a very, very good business. One of the things about hostile takeovers, a real showstopper, is having inside information. So these people were basically relying on the public record, just like value investors now can. And the record is now so good. It's sort of unbelievable about what my analysts know about the companies they analyze. They make presentations twice a week, and they can be comprehensive and very, very knowledgeable. Impossible in Graham and Dodd's. I've got to go to one other thing. Much as I admire them, just so you know, they didn't know tiddly squat about credit analysis. They were just plain wrong. They were quantitative driven, and they were just analyzing on behalf of the par buyer. In their quantitative analysis, they missed completely the importance of covenants. To assume, either in the U.S. or Canada, that the risk profile is the same for adequately secured lenders than it is for subordinated lenders is obviously ridiculous. Their purpose, of those of you who read Graham and Dodd know, was that in analyzing a credit instrument, you ought to look at overall coverage, and your investment ought to be in the bond that has the highest yield. So it's subordinate. The worst possible advice you could give a creditor. I know from long experience. Let me now turn to how you analyze companies. Many people still follow the Graham and Dodd precepts and look at companies as strict going concerns. That is, companies staying in whatever line of business they're in, managed the way they've always been managed, financed the way they've always been financed, and as such, if you're dealing with such companies, there should be a primary emphasis on the income account. At the other extreme are investment companies. Nobody that I know of looks at a mutual fund and appraises it based on its reported net income. No equity fund. They're all looking at net asset value. And that's the other extreme, and that's an awful lot of companies. That's the companies in which we invest. The elementary truths are most businesses combine a Graham and Dodd type going concern with investment company characteristics. I am pretty sure that overall the investment characteristics dominate, except in the trading environment where everybody's looking at reported earnings or earnings versus content. Put it this way, anybody with a reasonable net worth is much more wealth creation conscious than they are income conscious. And that'll be most of you when you go out in the world. You're going to basically focus, after you meet your elementary living needs, you will focus on your net worth. And wealth creation or net worth is more a balance sheet concept than it is income concept. So that the environment Graham and Dodd were describing used to be a good description for integrated electric utilities and finance companies. It isn't even good for electric utilities anymore because they're no longer integrated and they all have investment trust characteristics. Well, let me go on and talk about how do you create corporate wealth? And we'll see where to place the emphasis. There are 4 ways to create corporate wealth, conceptually. 1, discounted cash flow, to have cash flows from operations available for the security holder. If you're an equity investor, to have it available for the common stock. That is the one thing academics focus on. They say, read Meyer, they say, cash flow is the thing. Baloney. Very few companies have positive cash flows. When people talk about you have to have a positive net present value, to which the money you put in to the present value of the money you put into a project has to be less than the present value of the cash flow stream to you. That is absolutely correct. That is important. But for Pete's sakes, that's project finance. It's not corporate finance. In corporate finance, most companies and practically all governments consume cash. They don't generate cash. So let's talk about what is the second way to create corporate wealth, which is far more common in terms of flows, and that is to have earnings. Earnings are defined as creating wealth while consuming cash. Believe it or not, any input-output chart you look at shows that that's what occurs for prosperous corporations, for losing corporations, for governments. Businesses consume cash. If they're good, they create wealth. And let's say we get that growth in net asset value I talked about. One of the things then about the requirement that there be earnings is that for most companies, earnings can't have an independent value unless the company also has access to capital markets, whether credit markets or equity markets, whether it's bank lenders or public lenders. That is true of almost, not almost all, the vast majority of corporations. Those two things, discounted cash flow and earnings flows, they are far, far from the only methods of creating corporate wealth. There are 2 others which I'd like to draw to your attention. One is resource conversion, a very, very big thing. That is redeploying assets from mergers and acquisitions, liquidations, spin-offs, changes of control, all things going on, and liability redeployments to massive stock repurchases, massive debt refinancing. All these balance sheet items are what goes on. A very, very important thing, resource conversion. I remember a few years ago in my seminars at Yale, I gave the class a project. Go to the Dow Jones 30 industrial average index, go back 5 years and see how many of the 30 were strict going concerns and how many during that period engaged in very, very significant resource conversion operations, whether mergers or liquidations or refinancing. Well, of the 30 had engaged in resource conversions. It is a very, very big part of the analytic picture. Understandably, not something that was on Graham and Dodd's radar screen. But when we do analysis around here, I mean, one of the things we worry about, is a company going to get taken over? Is it going to go private? There's a lot more to almost any business than just operations. And I don't think that was on Graham and Dodd's radar screen. The fourth thing about creating wealth, you can almost look at, I think more wealth is created this way than any other, and that's having super attractive access to the capital markets. Whether it's an IPO boom, where you can sell stock to the public at astronomical prices, or you're a real estate operator who can finance out a project with long-term fixed-rate, non-recourse mortgages. I think a huge amount of wealth for individuals has been, and for corporations, has been created by having super attractive access to capital markets. Let me now go back to net nets and contrast what we do with what Graham and Dodd talked about in net nets. What Graham and Dodd talked about was the attractiveness of investing in companies where net working capital, as defined by looking only at a classified balance sheet, exceeded the price of the common stock. That was when all they used was a classified balance sheet. We, on the other hand, feel quite differently in defining net nets. First of all, we're not interested in net nets unless the company has a super strong financial position. And then we, instead of looking at accounting classification of a balance sheet, our definition of current assets goes by what our analysis says is a current asset. Suppose we have invested, like we have in Forest City or Brookfield Asset Management, that owns fully leased Class A office buildings with creditworthy tenants on long-term leases. Those office buildings are called a fixed asset. Who in their right mind doesn't know you could pick up the telephone and sell any of them? And I said that long before the equity office property deal. It's always been true. So while for classification purposes that's a non-current asset, for our analysis it's a very, very current asset. It is near cash. On the other hand, let's say Kmart of Canada's inventories, merchandise inventories, are classified as a current asset on the basis that if Kmart of Canada were to liquidate, those assets would turn into cash within 12 months. However, Kmart of Canada is a going concern and will remain a going concern, and the inventory they have, if they're going to stay a going concern, is very, very much a fixed asset. If they have $2 billion there, if they want to stay in business, they better keep it at $2 billion. And for us, that's a fixed asset of the worst sort, subject to shrinkage, subject to markdowns. But for Graham and Dodd purposes, for classified balance sheet, it was called a current asset. So we differ. I think this is an important point because a lot of people complain there aren't any nets anymore. Well, maybe there are in Graham and Dodd nets, but we seem, if we're analyzing properly as I think we are, we seem to be finding a lot of them. George, how much longer shall I go before I open up to questions?
10 minutes.
How much?
10 minutes.
Good, okay. I'll try and do that. Okay, in Graham and Dodd, they were focused on passive investing by outside passive minority interests. I think what we and other value investors do, in the technique, certainly in the techniques I describe in Safe and Cheap, are also applicable to control investors who are very much like us, distressed investors, I'd even say venture capital promoters, and certainly most creditors. So in a sense, we're directing, or I'm directing my comments to a different audience than what Graham and Dodd, their sole constituency, it seems to me, was an outside passive minority investor. And there's some excuse for Graham and Dodd, a lot of excuse. If you basically think of all businesses going concern, yes, indeed, there is a primacy of the income account. In the trading environment, obviously there is. However, if you start assuming that businesses have investment trust characteristics, there's going to be a lot of resource conversion. By God, you need a balanced approach, and there is no primacy in the income account. And again, I repeat, for most people in their personal lives of any substance whatsoever, they're net worth conscious rather than income conscious, which means they're not looking for a primacy of the income account. Well, like I said, how many investors do you know in your studies who basically focus on only their interest and dividend income and couldn't care less about the market value of their portfolio? Or an individual investor focusing only on interest income and dividend income is giving a primacy to the income account. Okay, one other thing about why we keep adjusting accounting. All accounting is wrong. Can't really reflect the real world. It's worse now that we have rigid rules. But even without them, accrual accounting, which is GAAP, has a shortcoming, as you know, in that it doesn't adequately account for the cash experience. Cash accounting also has much wrong with it, in that it doesn't account for the wealth creation experience. And what the actual wealth creation experience is, what the actual cash experience is something to be determined by the analyst. Appropriately weighted, appropriately adjusted to his judgment. The people who prepare financial statements can't do it for you. You're going to have to end up using your judgment and do it yourself. Okay. I'm going to talk about, since we're sending books tomorrow, on this net asset value and growth in net asset value as a basis for investing. That will be the July 30th, 2006 stockholder letter, pages 468 to 476. Graham and Dodd visited April 30th, 96, pages 69 to 76, and January 30th, 98, pages 112 to 120. About modern capital theory, April 20th, 2003, pages 304 to 309, and the general theory of market efficiency. I'll do that with you before I just make a few comments. The general theory of market efficiency is January 31st, 2005, pages 392 to 396. Let me just briefly talk about market efficiencies. We think of markets, some markets have a tendency to instantaneous efficiency. Some markets have a long-term tendency toward efficiency, but mostly never get there. And some markets are inherently inefficient. Which market dominates depends on four factors. The first, who the investor is, or someone not well trained in value, someone on margin, or someone vitally affected by day-to-day market fluctuations for whatever reason. They face a market characterized by almost instantaneous efficiency. Two, what the security is. Market securities that are very simple and are analyzed by reference to very, very few computer programmable variables tend toward efficiency, tend towards instantaneous efficiency. Those are, that I could tell, there's only three types of instruments: credit instruments without credit risk, derivatives, and risk arbitrage, where risk arbitrage is defined as workouts, relatively determinate workouts in relatively determinate periods of time. But insofar as you get a knowledgeable investor and you get a complex security, there's a tendency for markets not to be efficient. The third characteristic of efficiency or lack of efficiency is how long is the investor's time horizon. And so far as an investor like Third Avenue can take a 3 to 5 year point of view, the market's inherently inefficient, or tends toward that way. And most markets, I guess for most securities for us, meet this second category. I'm always reminded I was a big investor in public service company in New Hampshire, second mortgage bonds in the late 80s. That was a company going bankrupt. But I knew based on analysis that they were adequately secured and it was almost impossible that they'd ever miss an interest payment, whether in Chapter 11 or not. I bought those instruments at about a 22% yield to maturity. A few years later, Tucson Electric got into trouble. There's a 15% yield to maturity. Some years after that, Pacific Gas and Electric filed in 11, and its first mortgages basically sold at a 9% yield to maturity. Yes, the market did tend to efficiency. Yes, it took 11 years. You know, in complex security. Finally, in talking about market efficiency, some markets are inherently inefficient. Suppose some of you go to be a corporate manager. I just picked that up. Or you get to be a venture capitalist. You know that if you have a 5-year time horizon, sometimes there will be IPO booms where you can get fantastic prices. Sometimes there's no way you could market any equity. Depends on more, but you just be opportunistic and take care of the market, which you know over time will change. The same will be true if you go into being an investment builder in real estate. Sometimes you know if you can take a long-term point of view and be comfortable. Sometimes the market will be great for you. Sometimes it won't be. The final thing I want to say about market efficiency is to talk about markets that are always inefficient. Unless, let me define a market first. A market is a commercial or financial arena where each participant reaches agreement as to price and other terms which each participant feels is the best reasonably achievable under the circumstances. And I got to tell you, if there's no external force to impose discipline, you can rest assured that market efficiency means that the participants not subject to discipline are going to earn excess returns, and they're going to earn them on a, believe it or not, a relatively consistent basis. It's just a fact of life where people are doing as well as they reasonably can. If nobody is to sit on them, they're going to earn excess returns. Excess returns to some people mean a lack of efficiency. What are these external forces? They're competition, like you have on the floor of New York Stock Exchange. There's governments, regulators like the SEC and the Ontario Securities Commission, their boards of directors, their unions, their communities, and so forth. But there are a large number of people not subject to disciplines, and boy, they earn excess returns. Need you look at top management compensation in the United States to see that. Need you look at the underwriting community where everybody has a 7% growth spread to encourage IPOs. There are all sorts of areas where excess returns are earned because there's a lack, there's no imposition of discipline. Let me, since I have 15 minutes, I thought you might be interested in what we're doing in the Third Avenue portfolio. All these nets that I'm talking about. So let me name some names. And it's amazing about the amount of investing we're doing in the Far East, to wit, Japan and Hong Kong. Let me give you my list of 9 nets, which amount to 51% of the Third Avenue portfolio. First one is a combination of Chung Kong Holdings and Hutchison Whampoa, which is 10.7% of the equity portfolio. The second is Toyota Industries, 8.9% of the portfolio. Toyota Industries being a way to buy into Toyota Motor at maybe a 30% discount. Henderson Land, Henderson Investment, another Hong Kong-based business, 8.1% of the portfolio. Forest City Enterprises, 4.2%. St. Joe, 4.2%. Brookfield Asset Management out of Toronto, 4.1%. POSCO out of South Korea, 3.9%. Neighbors Industries, that's probably the only pure earnings play of the 9. I should leave them out, 3.4%. And Investor AB in Sweden, 3.2%. There are these types of securities around. I think there are reasonable opportunities to acquire nets at some sort of discount, qualified by the fact that the businesses have to be extremely well financed, and that you as an analyst conclude they have some prospects for long-term growth that will result in an increase in net asset value on average of not less than 10% a year compounded. Most of my guys here are doing, all of them are doing a lot better than 10% so far. And I got to say, I'll just conclude by saying all of my Hong Kong people have huge presences in the People's Republic of China. And they may have huge growth potentials. Which makes one final comment I will direct mostly to George, because I got a memo about growth stocks. When people talk about growth, they don't really mean growth. They mean generally recognized growth. And to acquire generally recognized growth, you have to pay up. We'd have to pay up. I suggest in the portfolio, I think about the portfolio, it is a portfolio with great growth potential. It's nowhere recognized. It has no general recognition as well. With that, let me open it up to questions in the remaining time we have.